Public Service Loan Forgiveness and Temporary Expanded Public Service Loan Forgiveness, featuring Ian Foss, Acting Director, Policy Implementation and Oversight, and Christine Isett, Product Manager, Public Service Loan Forgiveness.
Hi, everyone. Thanks so much for joining us today to talk about public service loan forgiveness and temporary expanded public service loan forgiveness. Given our limited time, let's go ahead and jump into our agenda. We're going to start by covering the basics of public service loan forgiveness. We're going to walk through an example borrower to understand the implications of public service loan forgiveness. We'll touch briefly on temporary expanded public service loan forgiveness. We'll touch on operations, some COVID-19 specific factors that relate to public service loan forgiveness, and then we'll close it up by talking about some programmatic data. But let's start with the basics. To receive public service loan forgiveness, a borrower needs to make 120 qualifying payments on a direct loan in a qualifying repayment plan while working for a qualifying employer when both applying for and receiving public service loan forgiveness. And there are a lot of qualifyings in what you heard me say there, and we'll break down each of what it means to be qualifying in a subsequent slide. But before we do, it's really important to understand that unlike certain other types of loan forgiveness that you may have heard of, public service loan forgiveness and temporary expanded public service loan forgiveness are not considered income by the Internal Revenue Service, which means that nobody needs to pay tax on any forgiveness that they receive through these programs. So we'll start by talking about the types of eligible loans, because this is the most foundational requirement for public service loan forgiveness. As you all probably know, there are or were 3 different major federal student loan programs that we've administered: the Perkins Loan Program, the Federal Family Education Loan Program, or FELP loan program, and the direct loan program. Only loans made under the direct loan program qualify. So Perkins loans don't qualify, FELP loans don't qualify. All direct loans do qualify, but there are some special considerations for direct parent plus loans that we'll talk about in a little bit. Ultimately, though, what this means is that if there's a borrower out there who doesn't have direct loans, or not all of their loans are direct loans, they need to do one simple thing in order to set themselves up for success with public service loan forgiveness, and that's consolidate the loans that they've received through the Perkins program, the FEL program, or direct parent plus loans into a direct consolidation loan to qualify for public service loan forgiveness. It's also very important to understand that only loans that are made after a borrower consolidates can count towards public service loan forgiveness. So if a borrower had, say, federal family education loans and had been making payments for 5 years on those loans, and then realizes that they need to consolidate their loans to receive PSLF, only payments that they make after they consolidate count. So that entire 5-year period before the borrower consolidated does not count towards public service loan forgiveness. And we encounter a lot of borrowers who don't understand this and then ultimately realize too late that they need to consolidate their loans in order to receive public service loan forgiveness. So it's important to make this determination right away. And luckily, of course, the direct loan program has been almost the sole loan program for about 10 years now. So this will impact fewer and fewer borrowers. But for those who have older loans, it's important to understand this concept. Qualifying employment is also obviously very important given the name, public service loan forgiveness. And a lot of people have different definitions for themselves about what counts as public service. And most people seem to think that public service matters what you actually do at your job. You need to be the doctor, you need to be the social worker. But for public service loan forgiveness, this matters not at all. It doesn't matter what your job title is. It doesn't matter what you do. It matters who employs you. It matters where you work. So what you see on this slide are the 3 categories of qualifying employer for public service loan forgiveness. You have 501c3 not-for-profit organizations. You have government organizations, and this is government organizations in the US at any level, so federal government, state government, local government, tribal government. And then it includes this last category, which is other not for profit organizations that provide specific qualifying services. And we have a list of qualifying services on our website that we'll link you to later. But it's really important to understand that in this last category, this other not for profit organization category, there are very few employers that we've actually found meet this definition. And you'll hear a little bit about how we're trying to improve the borrower experience by making this point very clear to borrowers. But when you're trying to explain this program to student loan borrowers, it's a lot easier to just say that it's government organizations and 501c3 not for profit organizations. These other not for profits can count, but it doesn't happen very often. Borrowers also need to work full time at a qualifying employer. And full time for public service loan forgiveness is the greater of whatever your employer says full time is, or 30 hours per week. So basically, what this ultimately means is that if you have, frankly, a really cool employer who says that 25 hours per week is full time, we will not acknowledge that employer's definition of full time. Instead, we will say that you are part time and that you need to make a 30-hour work week in order to be considered full time. Now, if you're like me and most other people who work in the United States and are held to a 40-hour work week to be considered full time, then that's the standard that you need to meet. Now, for those who do work part time and who maybe work multiple part time jobs, those jobs can be added together to get a borrower up to full time employment. So when that occurs, obviously we can't hold the borrower to two different employer definitions of what constitutes full time. And so in those circumstances, we say that the combined amount of time that the borrower works during a week must be 30 hours. And for those of you who have attended the session before, you'll remember my saying that for borrowers who work at a not for profit organization and who engage in religious instruction, worship services, or any form of proselytizing, they need to factor those hours out of the definition of what counts as full time. Well, there's actually a pending regulatory change that's due to take effect on July 1st of 2021, where it removes that restriction. And it removes that restriction retroactively in a sense. So even if there were periods of employment prior to July 1st of 2021, and borrowers had maybe not been considered to work full time because of this restriction, they can come back and recertify employment at now a higher level of hours to count periods of employment that might not have previously counted. Now, that won't happen until July 1st of next year, but once that restriction is removed, it will apply to all periods of employment, including those in the past. Qualifying repayment plans for public service loan forgiveness are critically important. And you'll see that at the top of this slide, the first qualifying repayment plan is the 10-year standard repayment plan. And that's true, that plan does qualify. But borrowers really need to repay their loans under an income-driven repayment plan in order to set themselves up for success for public service loan forgiveness. And income-driven repayment plans are the income-based repayment plan, the income-contingent repayment plan, the pay-as-you-earn, or revised pay-as-you-earn plans. And the reason why this is true is because the 10-year standard repayment plan is the repayment plan that ensures that your loans are repaid in full after 10 years of payments. Public service loan forgiveness requires 10 years of payments. So if a borrower made 10 years worth of qualifying payments under the 10-year standard repayment plan, they would qualify for PSLF in the amount of $0 because they'd have paid off their loans, because that's how the plan is designed to work. Now, if you're wondering why this plan qualifies at all, I don't think it's a cruel joke. Instead, I think it's designed to reflect the reality that the 10-year standard repayment plan is the default repayment plan for student loans. So if you enter repayment on your loans and you haven't chosen another repayment plan, you'll be placed on this plan. And so I tend to think of this repayment plan as a grandfathering mechanism for borrowers who maybe spent a few years in the 10-year standard plan before they really sort of understood what it was that they needed to do to qualify for PSLF, which is to get into an income-driven repayment plan. Qualifying payments for public service loan forgiveness. We've already said that you need to make 120 qualifying payments. And On this slide, we go through what that actually means. So you need to make 120 separate monthly payments. And as you can see, there are obviously exceptions because we're the government. We love our exceptions. But fundamentally, what this means is that you can't just write us a check at the beginning of your repayment for 10 years worth of qualifying payments and receive public service loan forgiveness right away. Instead, you need to make a steady stream of qualifying payments over the course of 10 years or longer, depending on your other repayment behaviors or employment behaviors. Now, these payments also need to be made after October 1st of 2007, which means that we've only seen borrowers potentially eligible for public service loan forgiveness over the course of the last few years. Those payments don't need to be consecutive, however, which is a big misconception about the program. And there are a lot of programs out there that require consecutive behavior. PSLF is not one of them. So if you were maybe working in the government for a while and then you go work in the private sector at a for-profit for a few years and then come back to the government or maybe go work at a nonprofit organization that qualifies, you pick right back up where you left off with public service loan forgiveness. You don't start over. Now, the payments that you do make must be for the full amount due under your repayment plan. So if you're due $100 a month on the income based repayment plan and you only make a payment of $50 in a month, that payment won't count. And you'll also be delinquent, which is not a good idea. The payments also need to be on time. And for the purposes of PSLF, on time means within 15 days of the due date. So there's a slight grace period here that acknowledges that sometimes you just forget when your due date is, or you forget to make a payment, or you had an unexpected expense and you needed to rejigger some of your finances. But payments, generally speaking, do need to be made on time in order to count for public service loan forgiveness. In particular, about the payment amount, multiple partial payments can add up to equal one full month of qualifying payment. So again, using my example of $100 a month, if you make a payment every 2 weeks, say, of $50 every 2 weeks, if you've paid your full $100 by 15 days after the due date, you can split that one qualifying month of payment up into multiple transactions in order to meet the requirements of this program. But generally speaking, payments that are made when they're not required don't qualify. So if your loans are in the deferment or forbearance, and we'll talk about a very limited exception in a little while, those payments don't qualify for public service loan forgiveness. So if you're in school, say, or you're in a deferment or forbearance, those payments won't generally count. In addition, with certain limits, and this is change, as you can see on this slide, it no longer matters how much you pay or how early you pay. If you satisfy the amount that you are required to pay with money, so if you had a payment of, again, $100, it doesn't matter how early you satisfy that payment anymore. You can still get credit towards PSLF even if you make your payment early. There are certain limits, and we won't go into that now in the interest of time. But there are a lot of borrowers out there who have been making early payments and who may have seen some of those payments not qualify for public service loan forgiveness, and that restriction has finally been removed. There are other certain exceptions for borrowers who have served in the AmeriCorps, Peace Corps, or who work at the Department of Defense. Those exceptions still apply, and they work a little bit differently than other types of lump sum payments. And again, in the interest of time, we won't go into those. But it's important to be aware that those exceptions exist and still apply, even though we've made this change. And so before we talk about temporary expanded public service loan forgiveness, we're going to walk through an example borrower who we've named Billy Borrower because I like alliteration. Billy is single and has no dependents and lives in Minnesota because I'm from Minnesota. And he has an adjusted gross income of $35,000 a year that rises at the rate of 5% per year. And, you know, in prior years, I've actually usually made the slight joke that my salary certainly doesn't rise at a rate of 5% per year. And it certainly feels like that's true for a variety of people. But we've actually recently done some analysis on the incomes of borrowers who are enrolled in income-driven repayment plans. And actually, on average, their incomes are rising at about 5% per year. So my joke is no longer a joke. It's actually serious. So Billy is, at least in this respect, an average borrower. And he has $50,000 of direct loan debt. 23,000 of it is subsidized, and all of it has an interest rate of 6%, which is not how a borrower's debt would typically work, but it certainly makes the math a whole lot easier. Billy is also borrowed for graduate school. And so, one of the things that it's really important to understand about Billy before we talk about how income driven repayment and public service loan forgiveness will work for him is that though Billy may be average in the amount that his income rises per year, he's not average in terms of the amount that he owes. Most borrowers owe a fair amount less than $50,000 per year. And as we segue over to the prior slide, you'll probably get a little bit of a better understanding about why I had to create a not average borrower to really show you a good example about how income driven repayment and public service loan forgiveness really work together. So, under the first two income driven repayment plans, the income contingent repayment plan and the income based repayment plan, those repayment plans independently, without public service loan forgiveness, provide forgiveness in their own right after 20 or 25 years, depending on the repayment plan and certain other factors. And so, Billy, under both of these repayment plans, which are the income contingent and the income based plan, both of which are the longest standing repayment plans, Billy actually pays his loans off in full in about 15 or 19 years, depending on the repayment plan. For pay as you earn and revised pay as you earn, Billy does actually independently get forgiveness under those repayment plans. But most borrowers are not in those repayment plans or traditionally have not been. And so it's important to understand that there's a fundamental connection between income driven repayment plans and public service loan forgiveness. And the connection is this: public service loan forgiveness is not a generally applicable repayment plan that applies to everybody who is working for a qualifying employer. It's a targeted program that is intended to benefit those who would have already derived a benefit from public income driven repayment, which is to say their debt was high relative to their income. And so they saw a reduction in the amount that they were required to pay relative to other repayment plans when pursuing income driven repayment. And so income contingent and income based repayment don't provide forgiveness for Billy unless they're coupled with public service loan forgiveness. And then when you consider pay as you earn and revised pay as you earn, Billy obviously sees forgiveness in higher amounts because 10 years is shorter than 20 or 25. So he has less time to pay off his remaining loan balance when pursuing public service loan forgiveness when compared to income driven repayment. So again, there's this fundamental connection between income driven repayment and public service loan forgiveness. And it's important to understand that this program is not intended to benefit everyone who works in public service. It's only a subset of those individuals. Temporary expanded public service loan forgiveness. This is a program that is designed to assist those who have not met the requirements for public service loan forgiveness only because some or all of their payments were made under a non-qualifying repayment plan. So temporary expanded public service loan forgiveness is a program that is only available to those who didn't qualify for PSLF because some or all of their payments were made at a non-qualifying repayment plan. And of course, temporary is in the name, and so we need to talk about what temporary means. It's temporary as a program because Congress appropriated a specific amount of money and set caps on the amount that can be forgiven. So Congress appropriated $750 million, and we cannot forgive more than $1.075 billion in loans. Once either of those caps are reached, either a cap on the amount expended through appropriations or the cap on the total amount forgiven, this program ends. And as a result of the fact that this program is limited in nature to specific dollar amounts, the program has to be administered on a first come, first served basis. Temporary Expanded Public Service Loan Forgiveness, or TEPSLF, was created by the Consolidated Appropriations Act in 2018 and has been expanded in terms of additional appropriations through subsequent appropriations laws. And for those of you who have been tracking the ways that you qualify for temporary expanded public service loan forgiveness, or the way that you apply for it, some of the reasons why we didn't have robust application processes is because the law actually required us to implement an application process within 60 days of the date that initial creation of TEPSLF was enacted into law. And so we'll talk about the application processes and some of the improvements. But before we do, we should talk a little bit more about the actual requirements for TEPSLF. So a borrower, to be eligible for this program, needs to not qualify again only because some or all payments were made on a non-qualifying plan. Temporary expanded PSLF or TEPSLF is not available to borrowers who have loans that were not direct loans. So this program is not designed to expand forgiveness to borrowers with loans under, say, the FEL program. It's only for direct loan borrowers. We also need to ensure that we haven't hit the cap on the amount that we can expend through appropriations, that we haven't hit one of the aggregate forgiveness caps. And in particular, and this is something that is unique to temporary expanded public service loan forgiveness, and it actually is quite difficult to say out loud, let alone understand. The borrower needs to have paid at least as much as they would have been required to pay under an income-driven repayment plan in the month prior to applying for TEPSLF, and in the month that was 12 months prior to applying for TEPSLF. So a quick example, if you have a borrower who was on, say, the extended repayment plan, which, as we know, does not qualify for PSLF, and was making payments in the amount of $150 a month, but the borrower would have been required to pay $200 a month under an income-driven repayment plan. This borrower can't meet that requirement because they paid less than they would have been required to pay under an income-driven repayment plan. But conversely, if this borrower was on extended and was required to pay $300 a month and was making those payments, and was instead required to pay $150 a month under an income-driven repayment plan, then this borrower would meet this requirement and would potentially be eligible for TEPSLF. Now, as you can see, again, we love exceptions. So there is an exception that is made for borrowers who have had an unusual fluctuation in income over the prior 5 years prior to applying for TEPSLF. I think this was a requirement that Congress created to acknowledge that while they wanted to target this repayment plan to people who genuinely would have continued to benefit from income-driven repayment, we also wanted to acknowledge that people's incomes change. People's income can drastically rise and fall, which is probably especially true right now in the midst of a pandemic and the recession and the financial difficulties that many people have found themselves in. So there is this exception that is available for borrowers who have had an unusual fluctuation in income, which we haven't seen many borrowers use yet, but is available to those who it affects. I'm going to touch briefly on some of the processes that we use before turning it over to my colleague, Christine. But it's really important to understand that we are actually fundamentally changing our processes for both of these programs. So we have a new and improved process. We started our PSLF process in 2012, in particular, January of 2012. And through October of this year, we had two different public service loan forgiveness forms. We had an employment certification form, which is what we wanted borrowers to use on a regular basis to document their employment so that they could get updated counts of where they were with respect to PSLF before becoming eligible. And then we had a separate application for forgiveness that borrowers would submit after they met all of the requirements for public service loan forgiveness. And then in addition, we had completely separate TEPSLF processes where the borrower needed to email a specific email address requesting temporary expanded public service loan forgiveness. And they need to have previously submitted a public service loan forgiveness application that ultimately needed to be rejected before the borrower could proceed with processing for TEPSLF. Well, obviously that became very complicated, especially after TEPSLF was created. And as a result of a variety of recommendations from a variety of sources, we actually have streamlined and improved all of these processes starting in November of 2020 and going forward. So now there's a single form that borrowers need to fill out in order to interact with public service loan forgiveness, temporary expanded public service loan forgiveness. And it doesn't matter whether or not the borrower is seeking forgiveness and merely trying to figure out whether or not their employment, loans, or payments qualify for the program. Borrowers submitting this form starting in November of 2020 will automatically receive a determination of whether or not they qualify for either PSLF or TEPSLF and will automatically receive it if they qualify. And if they don't qualify, they'll, of course, be told why and will be told how close they are to being eligible for either program. Well, now that I've taken you through the program requirements and a little bit about our processes, I'm going to turn it over to my colleague Christine, who will talk to you about some of the new and improved digital tools that we have available for borrowers. Christine?
Thank you, Ian. While Ian has discussed the actual PSLF program and requirements, today I'm highlighting steps the department has taken to improve the borrower's experience with PSLF. We first introduced the PSLF Help Tool in 2018 to help borrowers better understand the program and what they need to do to participate and possibly have their loans forgiven. In addition to PSLF, the updated Help Tool now assists a borrower to understand if they are eligible for TEPSLF. Some of the feedback we received from customers indicated they didn't know if their employer was eligible, which is one of the primary requirements for the program. Remember, Ian indicated earlier, it's not the person's position or job, but the employer that matters. This past summer, we added an employer eligibility database within the PSLF Help Tool. And recently in November, we added other enhancements to the tool to assist borrower to better understand whether he or she is in the journey towards receiving forgiveness. Today, I'll walk you through some of the updates and changes we've made. Let's look at the first employer eligibility database released in June. A borrower was able to conduct a search within the database to identify a match using the EIN and the employer name. Here's what it looks like today. You can see the employer eligibility database has been integrated with the look and feel of studentaid.gov and now has additional functionality. What I like and think is helpful is at the top of the screen, you can see the 5 sections of the flow so you know where you're at in the process. Once a borrower enters the PSLF Help Tool flow, they will see a My Employer screen in the Employment History section. In the employer search, the borrower is guided to provide the required employment information. After the borrower selects Search, they will be taken to a page with all the employers in the database that are related to the EIN they entered. Here, the borrower is prompted for more details on their employment history. It's also the section for a borrower to provide supporting documentation for employers that are considered likely ineligible or ineligible. This documentation is what the department uses to help make a determination on the eligibility for certain employers. To move forward in the flow, borrowers will select Save Employer. This is the section for a borrower to manually enter information on an employer that is not currently in the database. Here's another before and after instance. You can see how the Add Employer step looked in June with the initial release of the employer eligibility database. Since then, we have taken steps to improve the process as we know many borrowers have more than one employer in the course of their work history. As we proceed through the flow, you can see the loan eligibility section that previously displayed for borrowers and compare it to now. The more recent version of Section 2 that was a part of our November release has the updated look and feel and an improved flow. A borrower sees which of their loans are eligible for PSLF and or TEPSLF, as well as which loans are not eligible for either program. The borrower also sees information about how many qualifying payments they have made across a certain number of loans. If that information varies from loan to loan, the borrower will see a range rather than a specific number. If the borrower scrolls down, they will see an eligibility breakdown. In addition, the borrower will see a toggle where they can compare their loan eligibility between PSLF and TEPSLF. The borrower will also be presented with recommended or required actions such as consolidating loans, changing their repayment plans, or taking steps to get out of default. In the 2018 version of the tool, the next step of the flow helped the borrower through the process and guided them to select the correct form. It was either the employment certification form or the actual PSLF application. To apply for TEPSLF was altogether another process requiring the borrower to reach out to the servicer after having been denied for PSLF initially. Now, in the current flow, the borrower is prompted to answer a question as to whether they have made 120 qualifying payments. In more than 80% of denied applications, we found that borrowers have not been in repayment for at least 10 years, making it impossible to have achieved the 120 qualifying payment requirement. Regardless of their answers, the borrower will select Next Section to move forward. After selecting Save, the borrower will be taken to a Next Steps page with a warning banner indicating to the user that they're not finished. Additionally, the borrower sees the Recommended Action section. As you can see, borrowers must still print, sign the form, have their employer sign the form, and submit to the PSLF servicer. In the future, we are working towards digital signatures and submission. This brings us to the end of the Help Tool workflow. I appreciate the opportunity to show you the work we're doing to assist borrowers interested in PSLF. And now I'll turn it over to Ian.
Thank you, Christine. We're going to wrap up by talking about some data and some specific COVID flexibilities that are being provided. For those of you who have attended this session in the past, you will recognize some of these slides, but some of them are new. This is one of the slides that we provide at every conference, and it talks about what we call the PSLF borrower portfolio. These are direct loan borrowers that have at least one approved public service loan forgiveness form on file. And as you can see, over time, we've seen a steady increase in the number of borrowers who have such forms on file. And we're at 1.33 million borrowers as of August of 2020. So we're seeing a steady increase. In terms of the breakdown of the type of employer that's being certified, we still have a pretty strong predominant majority of borrowers who are certifying employment in various types of government organizations. And again, this is going to include federal, state, local, or tribal governments. So it can include teachers, firefighters, policemen, people like me, and others who work in various capacities at all levels of government. It also, of course, the next largest category is 501c3 not-for-profit employers, followed by some very, very, very small percentages of employers who are in other categories. This is why we think it's important to emphasize government employment and 501c3 employment and de-emphasize employment qualifying in that other not-for-profit category. We've really seen very few employers qualify meeting this definition. This slide is also pretty constant in terms of us including it in our conference presentations, but we've put a new look and feel on it. In particular, we're tracking the number of borrowers who have made qualifying payments in various ranges over time. So as you can see, as the PSLF program has matured, we've seen more borrowers moving out of having made zero qualifying payments and into other categories. In particular, we've seen pretty steady increases in the number of borrowers who have made more than 2 years of qualifying payments and more than 4 years of qualifying payments. And we really expect this to be the trend over time. PSLF was a program that, while created in 2007, was also a program that was only available, as I've mentioned, to direct loans. But the direct loan program didn't become the predominant repayment plan loan program until 2010 with the conversion to 100% direct lending. And so many borrowers didn't have the either initial ability to receive direct loans or didn't know that they need to consolidate their loans into the direct loan program to qualify, meaning that we're expecting the number of borrowers who qualify for PSLF to increase over time as the direct loan portfolio matures. And as more borrowers have had the opportunity to consolidate their loans into the direct loan program. Some statistics about the help tool, and these are statistics that are valid as of when we implemented the PSLF employer database into the help tool, which was earlier this summer. So between July 1st and about mid-September, we've seen almost 250,000 users start using the help tool. We've seen almost 6% of those users be those who don't actually have any direct loans, which means they are definitely users who would need to consolidate and shouldn't be filling out any of these PSLF forms until they do so. And we've seen just about a third of borrowers actually go through the complete flow to generate a public service loan forgiveness form, which is a statistic that we'll be closely monitoring over time, especially after now that we've implemented our redesign of the public service loan forgiveness help tool to see whether or not this percentage is increasing and whether or not there are further enhancements that we can make to the design or functionality to ensure that our tool is not the reason that borrowers are not completing public service loan forgiveness forms. But while the number of borrowers who are completing the PSLF help tool flow may seem low to you, we're pleased to report that the number of employer searches that have been conducted in the help tool database since its launch is actually quite high. And the number of employers that borrowers have searched for that have been in the database is also very high at over 80%, which is indicating to us that our initial attempt at creating a list of qualifying employers that is in the database was actually a pretty good first start. Of course, we'll be adding employers to the database on a regular basis as we make more and more determinations about whether or not employers qualify for the program. But here are some statistics about employers that are either eligible or ineligible in our database right now. As you can see, there are over 1.5 million employers in the database right now. Almost all of them are eligible employers. We have a small number of employers who we have determined are not eligible. But it's also very important to understand that this is just the employers that are eligible or ineligible in our database right now. There are a variety of other types of employers in the database that show up when a user searches as likely ineligible. These are other not-for-profit organizations that we haven't made an eligibility determination about yet. And so because we know that there are so few organizations of this type that we've determined qualify for PSLF, we wanted to really set expectations for borrowers about whether or not they were going to have a realistic chance of qualifying for the program. Those borrowers are free to apply, even if their employer shows up as likely ineligible. We just recommend that they submit some type of additional documentation to help us in our review. It's not required, but it will hopefully speed up the process by which we make a decision about whether or not these types of employers qualify. But even if a borrower doesn't, we'll do our own due diligence to make the best decision we can based on the information that's available. As Christine mentioned, of direct loan borrowers who have applied for PSLF and who were ineligible when they applied, over 80% of them had not been in repayment for 10 or more years. So this really determined for us that there's a fundamental misunderstanding of the requirements for public service loan forgiveness, or there was a misunderstanding about which form it was appropriate to fill out for a borrower. This is one of the reasons that we combined our forms into a single form. So whereas a borrower before needed to choose whether or not they should fill out an application or an employment certification form, now borrowers will fill out a single form and they have the opportunity to indicate whether or not they believe they qualify for forgiveness right away. And we'll be using this to track whether or not borrower expectations of their own eligibility are matching up to what they are actually eligible for in reality. And we'll continue to assess whether or not the number of borrowers who actually qualify or believe that they qualify matches up to their true eligibility, and use that information to try to further enhance our processes and tools in the future. So far, we've still seen a low number of borrowers qualify for both PSLF and TEPSLF, which again is expected. This is a program that's going to take time to mature, And over time, we expect more and more borrowers to actually qualify for forgiveness. But remember, borrowers who apply for this program and who were determined to not be eligible can reapply whenever they become eligible. So, receiving a so called rejection letter is really just a message to the borrower that you don't qualify yet. This is not our way of saying that this borrower can never qualify for forgiveness. They just don't right now. And so we hope that the improvements to our processes will really assist borrowers in better understanding where they are in terms of eligibility and how much longer they have left to go. Before we end, I want to touch very briefly on some COVID-19 flexibilities that apply to both of these programs. In particular, the CARES Act, which was passed back in March of this year, and some executive actions that we've taken mean that the borrower for the period of March 13th and through the end of this calendar year, the borrower doesn't need to be making payments to get credit for PSLF or TEPSLF so long as the borrower continues to be employed full time while the borrower is not making those payments. And so these borrowers will automatically get credit for having made a payment, even if they didn't, as though they made a qualifying payment towards PSLF, and we will automatically count those months of suspension when borrowers don't need to make payments towards the TEPSLF specific requirement that the borrower make as payments as much as they would have been required to pay under an income driven repayment plan before qualifying for TEPSLF. So for borrowers who are currently in a suspension status, they don't need to make payments in order to get credit for PSLF or TEPSLF, but they do need to continue to be employed by a qualifying employer during this time. And now we're reaching the end of our presentation. I want to highlight for you a few resources that we have available for borrowers about public service loan forgiveness. We have our public service loan forgiveness and TEPSLF informational pages on studentaid.gov, as well as a link to the PSLF help tool, which is moved from studentloans.gov to studentaid.gov as our digital and customer care contract implementation matures. And we now have a short link to the help tool, so borrowers can go to studentaid.gov/PSLF to immediately be dropped into the public service loan forgiveness help tool. And with that, I'd like to thank everyone for tuning in today to watch our presentation. We're very excited about all of the enhancements that we've made to all of our processes for these programs, and I hope you look forward to further enhancements in the future.
Yes, thank you, Ian, for the opportunity. We appreciate getting to share some of the things that we've done with the PSLF help tool, and we hope that borrowers are better able to use the PSLF help tool and understand the program requirements.